Hi guys, good morning. I hope that everyone is having a really good day so far. I haven't been much active over the past 2 weeks. One of those reasons is because of this report. I've been making it pretty much since the start of last week. This was released yesterday, and then the week before that, I actually took a break because I've been posting a lot of videos constantly since I started this channel. I'll be getting back to posting videos daily, hopefully. A lot of people requested me to do a video on this report. They had a few doubts on certain areas. So I will be clarifying those doubts on this video as well. And we'll pretty much go through all the slides that I posted, and I'll just give a rough idea on my thought process and what went behind what I was looking at when I was making this report. Let's quickly get into this. I'll try my best to make it as short as possible. This report was posted by SoftLogic. It was not some personal report that I posted. It was an official report that I did and was posted through my company, which was SoftLogic Stockbrokers. Just a disclaimer: none of these things are guarantees. Obviously, you should never make any of your investment decisions solely through looking at reports or any sort of other public information. Make sure that you make your own thesis and come up with why you're going to buy a stock or sell a stock before you jump into conclusions and so on. And do not make public information your first source of information. Always have your own thesis before you make any sort of investment decision. That's about it. Pretty much you guys know the difference between fundamentals and technicals, so we don't have to go through that. So let's jump into the intro. The intro was pretty much explaining what has happened so far. So we already know that the index has retraced roughly around 2,500 points from its all-time high. So a pretty steep kind of drop. Nothing new. If you were there during Jan of last year, this was very similar to what happened back then as well. So it's becoming sort of a thing in the market to retrace like this, especially things like this happen when prices go up too fast. So nothing new, it's just the normal volatility, so you need to get used to it. As of now, there have been obviously a lot of news going around as to why it happened, from the current economic situation, the current war going between Russia and Ukraine, interest rate hikes, IMF news. Now, this IMF news, it's a bit of a confusion. I think the long term will be really good for the market, so we'll get into that part as well. And then there was obviously margin clearance news and stuff. Now, the thing with margin clearance is that it's obviously going to happen, right? When prices drop too fast, margin clearance are going to happen. Margin clearance doesn't happen. I don't think it happened around the 12,500, 13,000 area. So when prices drop and when you don't have an idea of where the key support levels are, you're always going to get margin calls, because once those levels get broken, prices are going to tank really fast, especially if it's a key level of support. So that's why it's very important to know your support levels on the chart when you're in a trade. That's that. And then throughout this report, like I've explained, we'll be mostly focusing on the longer term, which is more important. We'll obviously have a range of charts from the hourly, weekly, daily, and even the monthly. So we'll be having a very big overview of the market across multiple time frames, which is what you need to do. Yeah, right at the bottom, the important part, needless to say, nothing of which is written in this report is guaranteed, and the market participant is advised to form his or her own thesis with regards to the market first before relying on public information. That's about it on the intro. So let's quickly dive into the key charts that I posted. The first one is diving into a possible secular bull market. Now, a lot of you people probably might not know what a secular bull market is. So a secular bull market is pretty much a very long-term bull market. Now, there are different definitions on what might be called a secular bull market. Now, some say that it is a bull market that spans for at least 20 years or so. So that's one definition. Another definition is usually as long as prices are above the 200 above a rising 200 week moving average, then you can call the prices are in a possible secular bull market. So there are several definitions. As of now, we have used a definition with regards to the 200-week moving average and not the 20-year whole explanation, and I'll tell you why. So with regards to CSE, if you once I start explaining, you'll get it. But with regards to CSE is a volatile market. So when prices rise, it rises quickly. So you cannot really, take in the definition of 20 years, because prices can't sustain rising at those rates for 20 years, which is why from what I have seen, the natural cycle has usually been around 7 to 8 years. So that is why our ones are a lot shorter now. If you look at the US markets, they have pullbacks towards the 200-week moving average before it starts rising again. So that's why their bull markets are actually more persistent over the long run. So that's why they have, bull markets that span for 20-25 years. So that's why definitions might vary. So we have to obviously give flexibility. So as of now, we'll be using the 200-week moving average. So if you look at this, the image below will describe what is known as secular bull market. Generally, a bull market is defined when prices are above a rising 200-day moving average. Now, don't confuse yourself with a secular bull market and a normal bull market. A normal bull market is pretty much over the medium term. So that means that prices are above a rising 200-day moving average or a 40-week moving average, which is the same thing. So as of now, we are just looking at the secular bull market, which is a much longer term bull market. So right, so here at the bottom of the area over here, we can see several setups can be derived from the chart. Something very easy for the reader to see is that prices, after breaking through the 200-week moving average, has entered into a long-term run-up of roughly 7.5 years. We have seen this from 2002 to 2008, and then again from 2010 to 2016. So let me explain what I'm saying here. So you see this breakout above this black line is a 200-week moving average. This the more volatile line, which is the light blue line, that is a 200-week moving average or the 200-day moving average. So forget about that. We are focusing solely on this black line. So you can see that over here where my cursor is pointing towards was around 2002, just before the start. I was actually in 2001, close towards the end of 2001. So here you can see that once prices broke above this moving average, we entered into a long-term run-up that spanned roughly 7, almost 8 years. So you can see this 200-day moving average. You can see the prices have been fluctuating around it. That is fine. Our main focus is that we hold above this 200-week moving average. So as long as we are above that, we are in an overall secular bull market. So there's one other thing that you need to look at. So you can see that every time after the 7.5 year span, we have entered into a very steep and quick correction. Now these aren't corrections, these are actually bear markets that have been very steep and quick. Now you can see these two highlighted red areas, right? So there's something in common in both two areas, was that both of them were globally induced bear markets. So one was a global financial crisis, and then we had the COVID-19. So what you can expect is, here's one prediction that I have. So if this sort of setup is to work again this time as well, we might see this run continue towards the end of 2026. That's provided that we keep holding above the 200-week moving average, and then we might run, or we might even see a possible globally induced bear market towards the end of 2027. So historically, we see a similar sort of price action happening here as well. Whether it will happen or not, that's up to the market, but we obviously are trying to figure out a way to read the market, and as of now it looks like we might have something very similar to what we saw in the previous two cycles over here as well. So right, what more can we see? Prices have encountered a mega correction right after the phase, which has generally been a globally induced downturn. So that's the GFC and the COVID-19. So right now CAC seems to have entered another possible secular bull market, which can, bearing in historical data, run up towards 2026. While we have looked at the 200-week moving average, we also need to factor the 40-week moving average or the 200-day moving average, which is highlighted in blue on the chart. The expectation here is that prices should continue to hold above it over the medium term. This has generally been the case throughout the past two secular bull phases. So right, so we got that part here, which this we'll come back to this when I explain the Elliot wave theory as well. which kind of will explain how the whole 7 years of price action is going to work. So right, let's move into this one. So now we are looking into the Elliott wave. Now the Elliott wave has been very useful and is very useful in predicting major trends and major trend shifts. So this is globally known, and it's a very effective method. It works in crypto, it works in currencies, commodities, stocks, everything. So everyone, a lot of the professionals know this very well. So it's important that we also get to know it, because it has a lot of predictive power. So let's look at this. So Elliott wave theory is a form of technical analysis that looks for recurrent long-term price patterns related to persistent changes in investor sentiment and psychology. Using this has continued to be very effective across global markets. The image below looks at the monthly chart of the ASPI and the wave and what wave analysis tells us about future price movements. So generally, a normal Elliott wave bull market has a total of 5 waves. So you have 3 impulsive waves or 3 bull waves, and then you have 2 corrective waves, which are numbered as wave 2 and wave 4. So there are a lot of waves in this. Let's focus on the more longer term. So you see these 3 long arrows, right? Now those are the 3 big waves, or the 3 impulsive waves, which is wave 1, wave 2, wave 1, wave 3 and wave 5. So the odd numbers are the bull waves, and the even numbers are the bear or the corrective waves. So then you have wave 2, which is this part over here marked in corrective wave, and then you have the second corrective wave, which is wave 4, which spanned roughly 10 years between that 2011 top all the way towards the COVID-19 lows over here. So right, so this becomes a very important part of predicting where might CSC go towards the end of this year. So you can see, like I said, generally a bull phase in the Elliott wave analysis comprises of 5 waves. So now we are in the 5th wave, which also is the final wave of the bull market according to Elliott wave analysis, and which is why I also said since the beginning that we have one more wave left in CSC. Now whether it happens or not, that's not up to me, but as of now it looks like we have one more all-time high to reach in CSC. So right, so now this chart was made when prices were at around 11,600. So we have come towards a low that I marked here, which was roughly around 10,500. We stopped around 10,600. So we have been roughly coming to that point, and we retraced and gained roughly 500 points on there and closed the week at around 11,100. So good recovery, but we obviously need to see a consolidation phase like what we saw in March, April of last year, which will be very healthy for the market to gain more momentum to push towards a new all-time high. So the more important thing to note here is that we are in the final wave. What happens then is we enter into a more longer term correction. So you see this ABC correction, right? So that is the next part of the Elliott wave theory. So the Elliott wave theory has 5 waves, which comprises of the overall bull market, and then we have the corrective or we have a pullback phase where we see an ABC correction. So as of now, it looks like we'll reach an all-time high, and thereafter we might enter into a more strong correction on the market. So whether that happens or not, again, it's not up to me, but as of now it looks like that's what's going to happen. So overall, this also matches with my previous analysis of the secular bull market theory. Now remember that prices, if we are to enter secular bull market, prices don't always need to hold the 200-day moving average or the 40-week moving average. It can come towards a 200-week moving average. So what we can see is possibly a consolidation above 10,600 and then a push towards a new all-time high. It can go anywhere, but as of now I'm targeting the 17,000 18,000 range. If it goes there, we might see this 200-week moving average, which is currently at 6,400, to possibly come towards this 9,000 9,500 or even this 10,000 area. So bearing that in mind, that corrective phase, the ABC correction, which is a more longer term correction, might test the 200-week moving average, breaking below the 40-week moving average. So that is generally fine, because if you see this pullback over here, which we had after 2011 top, you can see the prices pull back right towards the 200-week moving average and then went up higher again. So then we had another market where we kept moving higher from, I think, roughly around 2000, mid of 2012 all the way towards around I think towards the end of 2050. So after 3 years the market went higher. So that's generally what you might see if this Elliott wave analysis materializes. Now what's more important is the amount of price action included on the chart. Now if you haven't figured it out yet, this is the monthly chart, and this Elliott wave analysis starts on roughly around 2002. So you're looking at roughly 20 years or 2 decades of data in over here, so which makes it much more important than looking at an hourly chart or a daily chart or even a weekly chart. So the fact that we have a lot of data in one area and all of those are taken into consideration makes this setup much more important than anything else. So as of now, I am starting to be very bullish on the market. Obviously too early to say until we see a proper consolidation phase, but looks like the hard part is over now. It's a matter of finding support and consolidating for a favorable amount of time so that we can gain enough demand in the market and volume can pick up, and then we can break out higher and move to an all-time high. So hopefully that happens. That's obviously up to the market, but as of now, let's see how it goes. So that's about it on the Elliott wave analysis. So this last slide, which is the last slide about the Elliott wave analysis, I've taken the final wave with the fifth wave and I've zoomed it in, and we have taken the weekly chart. So you can see that again we have a nice Elliott wave setup here as well, where we have wave 1 and 3, which is already done, and then you have wave 2 and wave 4, which is a corrective wave, and then we have the final fifth wave that might most likely take us towards a new all-time high. So like I said, we need to see a consolidation phase like what we saw here. You can see that, right? You can see a clear sideways or even an ascending triangle or cup and handle, whatever it is. We need to see a base form above 10,600. So if we can see some sort of like this, some possibly an ascending triangle or a symmetrical triangle or something, a base form here for a few weeks before we start moving higher, that would be the best case scenario for the index, so, and the overall market. So that's about it. So here, like what we have looked at a more longer term viewpoint of the market. So when it comes to long term viewpoints, we need to obviously consider the fundamental side of it as well. So that is very important, because the secular bull market is not just proven through just technical analysis. It has been proven, it needs to be proven through fundamentals as well. So if you look at where do fundamentals support the secular bull market theory. So the reason why we need to consider this is because of the fact that the market at some point reverts to its mean. Either the overall economy starts coming up or the market does. So very simply put, in the long term, we cannot expect the market to keep going higher if the economy is not obviously in tangent with it. So one thing can happen: either the economy recovers and starts catching up with the market, or the market drops and catches up with the economy. So hopefully we'll have the first thing, where the economy catches up with the market. So assuming that happens, here are 5 good reasons why we can expect the market to be in a secular bull market for the next 5 years, my bad. So first one is general improvement in tourism. So as we know, tourism is obviously a huge aspect of our country. It brings up most of the income towards the country. So we, after the 2019 bombings, we lost a lot of it, pretty much all of it. So we are seeing a recovery right now. We are seeing tourism levels pick up. So while Sri Lanka has continued to lose income from its main drivers since 2019, we have currently seen a much stronger pickup in tourist arrivals. Despite not being where we were in 2019, a continued pickup in tourism will yield a lot of benefits. So this will obviously improve our reserve position and all of that. So hopefully that works out. And then we have port city, which obviously is a long-term goal of the country, but at the same time it will be a game changer for the country if it actually works out. So as of now, we haven't really seen much FDIs come in with regards to that, but hopefully if it does materializes and income does come in, this will obviously drive the future of Sri Lanka. So that's one thing. Then obviously export growth, we have seen exports exponentially increase, and I don't know whether we are still currently at the pre-COVID levels, but if we are, then that's a good sign. What we need to see is this thing keep improving, because we do make a decent amount of money through exports as well. So then next thing, company fundamentals that everyone knows. We know that even at these prices, while CSE has appreciated a lot in value since the COVID-19 lows, our valuations still continue to remain very favorable with relative to what we had during 2011, where the PE ratio was roughly around 29 or something. So as of now, with the current drop, we are I think from what I heard was around 11 or 12. So even then, we are still looking at double, or even a bit more than that, if we are to reach what we were in 2011. So that's another thing. And finally, the IMF. So the IMF, there's a lot of confusion. Some people think it's negative, some people think it's positive. So from what I know, short term the market can take it either way, but over the long term it will always be a positive, because it will create more stability in the overall economy, which will eventually be reflected on the market as well. So long term will obviously be a good point to prove our secular bull market theory. Over the short term fluctuations happen. So like I said, it will depend on how the people take. Now, as of now, we don't have much foreign participation, so it will obviously be how the retailers in the country, the locals, take the information. Now, I heard that we are planning to go to the IMF in April. Whether it will work or not, I don't know, but if we do, then obviously it will depend on how the retailers take it and how the market prices in. So if the information is coming early, then we might see the market possibly price it in even before the news becomes a fact. So right, that's about it on that. Let's move into the more basics of technical analysis, which is the higher high, higher low, or the lower high, lower low setup. So as of now, by definition, if you're watching my previous videos, we have defined an uptrend through a series of higher highs and higher lows. So that's the most easiest way to look at a chart and see whether the price action is in an overall bull market. So let's read through this. Generally, an uptrend is defined through a series of higher highs and higher lows. This therefore would give us an idea on when we can expect prices to shift its trend and signal a possible bottom. So as of now, what we have is a complete opposite, which obviously defines a downtrend. What we have is a lower high, lower low, lower high, lower low, and it keeps going. And as of now, we are still yet to break this trend. So we need to break it to signal at least a possible bottom. Now, it might not signal a trend reversal, but it might signal a bottom, and we can expect this 10,600 low to hold. So for that to happen, we need to obviously break certain levels. As of now, it's too early to say. If we pull back, then obviously the Friday highs obviously becomes a level to break. If we continue higher, then obviously we will have to focus on this 10,400 10,340 11,340 to 11,500, that level to break. So depends on how Monday goes. After how it does, then I'll obviously update the chart so that you guys are updated on it. As of now, I can go two ways, but generally what I would like to see is 11,500 get broken. So from what I believe that the market will most likely consolidate between 10,600 and 11,600 before we start moving higher. Now, if you look at the previous price action in April of 2021, we had roughly an 800 point consolidation phase. We consolidated roughly between 6,800 to 7,600. So here also we might likely consolidate between around 10,600 to 11,600. So that's what I think the market might do. Again, up to the market to decide how it does. So that's about that on the lower high, lower low setup. What we need obviously is a clear break of this setup to signal a possible bottom. So there's no guarantee, but hopefully we will be able to get a bottom signal once this formation is broken. So right, so this is where few people were confused. They were wondering why there are these trend lines over here. So these are speed lines. A very famous setup. I don't see a lot of people using it here, but it's a very good signal of possible corrections and even areas where it might start consolidating. So let's look at historically how it has worked. So we can see this red line, which is the initial, which is, let's call it speed line 1. So here we have seen that once the speed line 1 was broken, we have entered into a more steeper drop and then we have consolidated. What's more important is this green line. This speed line needs to hold. If this speed line gets broken, we enter a reversal. So as of now, as long as prices hold above this green line, we are not in a reversal. And in April, we did hold this trend line, we consolidated and started moving higher. So now this green line is of no use for us. Now we are looking from this low towards this high. So the new speed lines are obviously this red line over here and this green line over here. Now we can see that once this red line was broken, again we entered into a steep drop, and then again, like I said, we need to continue to hold this green line. So as long as we can consolidate around this range, again I have made it 10,600, 11,600. So if we can consolidate base, form a base around this range and then break out, then again there's a likely chance, there's a good chance that we might break above the current all-time highs and move higher. So right, so that's about it on the speed lines. I hope everyone got it. It's a very simple but useful thing to know. So what's more important is obviously know that this green line is what you need to watch for. So as long as we hold above that and consolidate, then we are good to move higher if we do see an upside breakout. So the same way, now this is how we look for support levels. The same way we can look for resistance levels by taking the current all-time high and the current low. So as of now, you can see clearly the same thing what I explained here works in reverse over here. The most recent speed line is this speed line X, that needs to be broken first. So if we break that, that does not signal trend reversal, because like I said, like we mentioned in the green line over here, the green line here is this line over here. This is the one that will signal a trend reversal. For that to happen, prices need to convincingly break through this line over here, which is, we can call it speed line Y. So if we do break through that, one thing we might know is that we might have a more confident bottom at 10,600, and most likely that might signal that we might form a nice base, probably a cup and handle or some sort of base, and then break out and move towards a new all-time high. So that's about it on the speed lines. Let's move into this. So if you guys know, I was one of the very first people who told you that the market might come down towards these levels. So I told this well in advance when prices were roughly around, when prices first hit 13,500, which was in Jan 10th. Sorry guys. Okay, so as of now, we can see that there were several red flags. So as here on this slide, we'll be looking at why I turned bearish on the market over the short term. So here, let's read this part over here. While a lot of speculation was there on where the market would bottom out, we were firm on our assumption that the market would likely continue lower towards 10,000, 11,000 range. Several factors signal the reversal above 13,000, amongst which a few would be discussed below. So let's look at the chart. So here we have the 20 moving average and the 50 moving average. Take a look at the chart above. Right throughout June of 2021, we have continued to see the 20 MA and the 50 MA provide support and continue to have a positive slope on their moving averages. The above chart highlights 4 red flags. So what we have seen here on these orange marked areas is that prices were filtered with this 20 and 50 moving average. So the slope was positive on both of them, and prices continued to hold or get support from this moving average, which is completely different when we reach this 13,500 area. So the first red flag was when prices broke through the higher high, higher low formation on Jan 27th, right above 12,900. So I highlighted this on Twitter as well. I said that we have seen this trend broken for the first time since almost late May of 2021. So for a long time, we have continued to maintain this higher high, higher low formation, and the very first red flag was breaking through that. And at that point, I just felt, I had a really good feeling that the market would continue lower and we might have a much stronger correction than what a lot of people expected. So a lot of people thought that 12,000 would hold. I was like, there's no way that we are going to hold that level. So the second red flag was the slope of the 20 moving average which turned negative. Now if you watch my previous videos, I've always put a lot of emphasis on the slope of the moving average. It does not matter if the prices are above or below it, the slope is much more important. So if prices are below a 200-week moving average and the slope is still rising, there's a good chance that prices might pick up and get back above the 200-week moving average. The scenario would be a lot different if the slope turns negative. If the slope turns negative, that moving average automatically becomes a resistance level, and you can be a lot more confident that that will be a resistance level and that there will be no breaches back above that level. So the same thing happened over here. You can see we breached below the 20-week moving average and the pullback was stopped right there, and then we continued lower. And then we continuously formed higher low, lower high, lower low formations, which was explained over here on this slide. So that was second red flag. The third red flag, which is the break of the 20-week moving average, which was a bit more obvious for me, because when this moving average started turning negative, which never happened throughout this phase over here, it automatically felt a lot like the 50 moving average won't hold as well. A lot of people got caught in this pullback over here. Again, there were several red flags as well. One was the volume. The volume was constantly declining throughout this jump from this low all the way towards this level over here, and then the lower low, lower high formation was not broken as well, and that kind of was pretty much the icing on the cake to know that there might be a further dump towards the downside, and which was what happened. So that was the third point, and the final point was the continuous formation of lower highs and lower lows. So it was, now I wouldn't say it was that simple, but if you knew what you were looking at, you would have known that the market was going to continue lower, and you would have stayed out of it, or at least focus on stocks that were actually doing the opposite of what the market was doing. So if you knew your things, you would have obviously avoided this downtrend, but that's fine. Overall, the long-term trend still looks positive. So whether you are holding it now or not, if you're holding stocks that are index heavy, at least you might see them go to an all-time high, because if the index wants to go to an all-time high, then they need to go to an all-time high. So right, that's about it on this slide. Let's move into the basic support and resistance levels. So this is the old one. This is just to explain to you something of how when a certain support level is broken, it automatically turns into resistance. We have explained this before in one of my early videos. We call it the polarity effect, but regardless, let's look at it. As of now, we had two support levels that we were watching when prices were 11,600. One was the 11,600 range, which if it was broken, I clearly said that will come down towards 11,000. So regardless, I was giving a range on my Jan 10th video that we will consolidate anywhere between, our bottom would likely be anywhere between 10,000 to 11,000. So as of now, we are bottomed at 10,600, and hopefully that will be the bottom. So in that sense, this support at 10,650 is obviously now your key support level. So 10,600, 10,650 is a level that you need to watch for. And we have got back above this level. So as of now, we can expect this 11,000 range to become support as well. So our key level of resistance, like we have watched, but we looked at in the previous slides, is 11,000, the 11,340 to 11,500 range. So it also falls in this range. So most importantly, we need to breach through 11,600 to have more confidence of that we have, or most likely would have reached a bottom at 10,600. So these are the basic support and resistance levels as of now. This 11,000 range is always acting as support, and this 11,440, 11,640 will be the likely level of supply for the buyers heading forward, provided that we obviously hold above 11,000. So right, that's about it on that. Okay, we're moving into the final part of the report, where we'll be looking at indicators. So I've taken the two main indicators that a lot of people across global markets look at, which is the RSI and MACD. So here we have taken the weekly RSI, and you can see several things from this. So let's quickly look at this. Two key points to note for the investors here. The circle points on the chart all indicated downside reversals on the weekly time. So circle is this orange circles over here. So you can see that whenever the RSI crossed above this 80 to 81 level, we have moved higher, because it's generally when the RSI crosses above 70, it's not a reversal signal, it's a signal that the prices are gaining momentum. So rightly so, you can expect RSI to actually move a lot more than just 70. So above 80, when we have crossed above 80, we can clearly see that throughout pretty much 1996, so that's almost 26 years, for the past 26 years, almost 3 decades, every single time RSI has crossed above 80, it has signaled a reversal on the chart. Now it can be a short term, long term, regardless, it has been a strong reversal. So one very key important point to note is that. And the second thing was comparing the RSI of what it was relative to the March 2021 bottom. So you can see that the RSI back then and the RSI right now is exactly at the same point. So not a bottoming signal. I've explained to you that indicators don't signal bottoms and tops, it just gives you confirmation for price. So don't use indicators only to trade or do anything. Indicators are the third in my list. The first main two are price action and volume, and then comes indicators. So indicators can be used to confirm things, but never as something that should be solely relied on to make any sort of investment decisions. So that's about it on the RSI. We pretty much looked at the most key things. I hope you guys got it, nothing confusing. Finally, let's move into MACD. So the MACD, one was the bearish divergence, which acted as a confirmation to my reversal signal. There was a bearish divergence where prices moved higher, and the MACD histogram moved to didn't move to a higher high, which signaled a bearish divergence and an impending market top. And what happened thereafter was, obviously, we had a very strong reversal. Now on the flip side, we see a hidden bullish divergence as well. Now this has worked before as well. If you look at the next side, remember the time when prices crossed 9,000 for the second time, where we went to around 9,300 and reversed back to around 9,400, and we reversed back to around 8,400. I hope you guys remember it. It was at that point a lot of people said that we are entering a bear market and all of that, and all of those sort of things. And I highlighted on Twitter that we have a hidden bullish divergence which might signal a bottom, and that's exactly what we did. We went to a new all-time high after that. After that, we didn't even look back at 8,500. We went towards 13,500. So this has happened before, so we can have confidence in looking at this. We know that there is a stronger signal, since this is on the daily and this is on the weekly. This is a much stronger signal. Remember, the longer the time frames, the more important the signal is. So we have a hidden bullish divergence. Now as of now, what we need to see is obviously prices consolidate, and hopefully if it does, then this might also materialize and signal a possible bottom, and for prices start moving higher. So as of now, we have all the signals that we need, that the market has possibly reached a bottom in this area. It can be 10,600, it might be a bit lower or not, that depends on the market. But as of now, we have the signal that possibly prices are in a good bottom area, and for demand to start coming in, and hopefully with a favorable amount of consolidation, we might see an upside breakout, and then eventually prices running towards a new all-time high. So let's quickly look at the final conclusion. Most of what we have mentioned above gave you reasons and the red flags that arose very early for an investor to act on. At the same time, while we were currently trending low on the short and medium term time frames, the longer term time frames continue to favor the long side. So we have looked at all of that. The current downtrend, while it's heavily affected the sentiment of the market, investors need to remember that strong volatility doesn't occur on the upside only. Prices will correct quicker if it rises at a steep angle. Now I don't know why people haven't still got used to it, but I hope we get used to it on the next sort of downturn that we have, like what we have had this time and in Jan of 21. Similar thing, if it rises at a steep angle, it's going to come down at a much stronger angle. So just get that into your head. And finally, as of now, prices need to continue to consolidate while ideally holding the current lows of 10,600. We will continue to remain in a bull market as long as we are above the 200-day moving average. So over the medium term, as long as we are Our proxy is going to be the 200-day moving average. As long as prices are above it, we are in a bull market. So consolidating between 10,600 and 11,600 range for a favorable time will give the market the opportunity to attract more demand and let the volatility ease off. However, remember that with a contraction in volatility comes an expansion in volatility. So therefore, a favorable consolidation phase followed through by an upside breakout would likely initiate the next run to a new all-time high. So that's about it. I explained pretty much all the slides and all the important points and all the doubts that people had. So I hope that this was very useful. I hope that you guys watched the entire video. And to sum things up, simply I am bullish on the market and I expect a new all-time high. Hopefully we get it. So have your own thesis and hope that this also helps you in making a more conclusive thesis to make your investment decisions. So thank you guys, thank you for watching, and hope that all of this helped you guys a lot over the past few months. Thanks guys, and have yourself a nice weekend.